Hello, I'm Kristen King, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending themes in the market. This week, we're asking, should you position your portfolio for the so-called reflation trade and get ready for a return to economic normality? Investment bank Morgan Stanley thinks this is coming, but is there any evidence to support that claim? And if so, what indicators could we use to track it over the coming weeks and months? Everybody wants to put the pandemic behind us and return to normal. In order to do that, we need to reflate the economy, which means boosting demand and creating inflation, or in other words, creating excess demand, which is spread across all sectors and industries. That will be much harder to achieve in industries dependent on crowds and face-to-face contact. Some of these include bricks and mortar retail, dining out, and the wider travel and leisure sector, plus professional sports, casinos, and theme parks. The U.S. is a service-oriented economy, and while technology can support and deliver many services, it is the incidental and impulse purchases that we make as consumers that are missing. Back in September, coffee shop chain Starbucks predicted it would be at least another 6 months until its sales recovered to anywhere near pre-COVID levels. That is simply because we just aren't going to urban areas as often as we once were. The Federal Reserve is hoping to create excess demand through a combination of low interest rates and asset purchases, but so far there's been very little crossover into the real economy. Indeed, there is some evidence to suggest that the new money that has entered the economy is being hoarded rather than spent by businesses or consumers. Morgan Stanley's chief cross-asset strategist, Andrew Sheets, has a different view, however. He believes that growth and reflation will continue within the U.S. economy across the balance of 2020 and on into 2021 as part of a sharp V-shaped recovery. He and his colleagues think it's time to start reallocating resources away from technology and defensive stocks and into those assets that will benefit the most from reflation, namely smaller companies. Morgan Stanley can point to a bounce in the Russell 2000 index, which has gained 17.20% over the last 3 months as evidence that this is already happening. The S&P 600 small cap index is also up 16.4% over the last quarter, compared to 9.4% gains seen in the large cap centric S&P 500 index. Critics argue that while wage growth remains low and unemployment numbers are at a multiple of their pre-pandemic levels, there is more chance of the economy contracting further rather than expanding. They see low and negative interest rates actually depressing asset prices rather than stimulating them. Low interest rates are certainly associated with lower profit margins for banks, where new money and real assets are often created. One alternative might be for the Fed to raise interest rates or indicate that it is prepared to do so in the near term. However, the central bank has made it clear that it wants to see inflation pick up before it moves on rates, which creates something of a chicken or the egg situation. Looking at data from Trackstar, our proprietary search tracking tool, we can find evidence that Wall Street pros are exploring the reflation trade and the small cap space. Searches for small cap ETFs have been picking up in recent weeks across 8 different small cap ETF tickers, encompassing both value and growth strategies. Of course, because the stock market is forward-looking, we don't necessarily need to see evidence of reflation in the economy for the reflation trade to become a reality. We just need to see enough money rotate into the sectors and assets that have the most gain if reflation does materialize. In a sense, it can be a bit of a self-fulfilling prophecy. That's all we have time for today, but as always, make sure you do your own due diligence before making any investment decisions.